Hello, I am Lilian Onyenenere. Welcome to my channel. Today, we are going to look into journal entries. Journal entries. I'm putting it on the board. What is journal entries? It is a systematic way of recording your financial transactions in business. And journal entries is one of the documents you have to master well in your business. And if you do that, you won't find anything difficult at all. But before we dive deep into the journal entry, I'd like us to shift back a little into source documents. Source documents. Because from source documents, we now transfer to journal entries. What is document? Source document means the original record of financial transactions. In business, if you don't have a source document, that business don't happen. It is the proof a bookkeeper will use to start his work. Examples of source documents, like bank statements. And see it, bank statements. We have invoice, we have receipt, we have purchases invoice, and we have sales invoice. You can see that these bills are in pieces, and there's no way you can keep it fine in your business like this. So you have to transfer these bills into a single book called journal book. So let us look at the format for journal entries. The format, this dates, particular, date particular, folio, then debits and credits. Date particular, folio, debit and credit. This is format for journal. And we record the journal with a modern and traditional way or that is approach. Modern and traditional. Today we are going to look at the modern approach. Maybe tomorrow we look into the traditional way of recording journal. I promise you, you are going to understand everything well in this channel. So, the modern way of recording journal is something like this. Dinner. We call it dealer. Dealer. D-E-A-L-E-R. Dealer. You can see it. Dealer. D means dividend and drawings. Drawings. Then E means expenses. Let me remove this information. This one is dividend. Then E means expenses. Then A means assets. Assets. Then L means liabilities. E means equity. E means equity. Then R means revenue. R equals to revenue. When you master this thing, You won't find anything difficult in recording of journal, and mistakenly used permanent marker here. Okay, it's not going out. So when you master everything here, you won't find anything difficult in posting of journal, because this is the formula for posting journal. The formula for posting journal. Okay, D means dividend. What is dividend? Dividend is just a share of profits. A share of profits that a company pays out to its owners. A share of profits company pays out to its owners. Who are the owners of the company? They are the shareholders. The shareholders of the company. So they receive what is called dividend as a kind of thank you for contributing to the business. That is dividend. Share of profits company pays out to its owners for contributing to the business. Then now drawings, number 2. Drawing. Drawings means when the owner of the business take money from the business for personal use. When the owner of the business takes money from business for personal use, it is known as drawing. Then number 3, expenses. Expenses. What is expenses? It is just when we spend our money in respect to the business. When we spend our money in respect to the business, maybe we use the money to purchase stock, going to sell in our shop, and expenses. That expenses must be related to the business. Then assets. Expenses. Then assets. Assets means those things the business own for its running. But those things they own, it must have future economic benefits. The things that business own, which have future economic benefits. Example, delivery van, computer, furnitures, cash, etc. These are assets. Business owns these assets for its smooth running, and the asset must have future economic benefits. Then another one is liabilities. Liabilities. Liability means the money the business is owing to outsiders. What the business is owing to the outsiders is known as what? Liabilities. Example, loan is a liability. Bank overdraft, these are liabilities. Then equity. Number 5, equity. Equity means what? It means the net worth of the business, the total value of the business when the expenses have been deducted. It is just the net worth of the business. Some people call it capital, but it's more of capital. It is capital plus the profit that the capital had generated. Equity. Then 6, revenue. What is revenue? The income that we receive into the business. It could be in form of, that is the income, revenue, profit. These are known as revenue. Then, next now, if you look at the dealer, we have a drawn line in between like this. This drawn line means that this side DEA, they are for debit entries. Then LER are for credit entries. And debit means, as you know, debit means when you have T-shape like this, when you write at your left hand side, you have debited something. And when you write something at your right hand side, you have credited that. And debit and look at credit. Okay. Then let's move on. And two, this equity, we also have capital here. We also have capital. Equity or capital. Just like it is drawing or dividend. Not drawing or dividend. Dividend or drawing. Expenses, assets, equity or capital. Then revenue. Revenue in the form of income, profit to the business. So it's dividend or drawing that has this D. Then expenses, E. Assets, A. Enemies, liabilities, E. Equity or and capital. Equity or, it's not that C means capital, E means C. But is either we are going to record equity here and also capital under this. It's what it means there. Then revenue. So let us now look at it. Look at the rule. Look at the rule here. Look at the rule here. The rule of debit and credit. You can see it. Drawing. That is this group. Drawing. Anything that increases it, you debit the drawing. And anything that decreases it, you credit the drawing. Then expenses. Anything that increases expenses, you credit it. Anything that decreases it, you debit it. You can see it. Then assets. Anything that increases assets, you debit it. And anything that decreases it, you credit it. Liabilities. Anything that increases liabilities, you credit. The opposite of it now, because it is a credit balance. It has credit balance. Then anything that decreases it, you debit. Equity, the same thing. Anything that increases equity, you credit that thing because they are at the right hand side. And anything that decreases it, you debit. Revenue. Anything that increases revenue, you credit. And anything that decreases it, you debit. You can see it like this. You can take a screenshot. Take a screenshot. This is the rule. You are going to start the posting now. You can see it. Take a screenshot. Okay. Let's now dive into solving a question. Fast. Let us solve the question. Just one question. One question. Look at the question here because of time. I don't want this video to be so long. I wrote the question out. Look at it. You can take a screenshot. Take a screenshot so that I will proceed in journalizing it. The question says, journalize the following transaction. Journalize the following. Okay. Number one says, Ugo started business with cash, 2 million naira. You first of all draw the line. First of all, draw the entry. You first of all draw the line. On first, we go started business with cash 2 million naira. Look at the line. Dates. Particular. Folio, or some people are writing it as ledger folio, but I like using folio. Then debits, credits. So just okay, let me use DR and CR. Then underline. Okay, let us start posting. Before you start posting in a journal, first thing you have to do is when you read the question, look at, we're about to post this question now. Before you start posting, first thing you have to do, if you read the question, look into it well and analyze it. You find out the two accounts that are involved. When you find out the two accounts that are involved, you now know the one to be debited and one to be credited. Okay, we go start a business with cash, 2 million naira. You have seen that the two accounts that are involved here are cash accounts and what? Capital. He used to start the business. And if we go to our formula for journalizing, cash is under what? Assets. And cash has increased. And when cash increase, we debit. Okay. Number one, cash accounts. 2 million naira. Then cash account debit. Debit to what? To capital. To capital, 2 million naira. Sorry, don't put that in. 2 million naira. Okay. Number 2. You can write your narration being the recording of capital used for the business. Because of time, I will not be writing everything. Then 2, paid into bank 5,000 naira. So this one that involved are what? Bank account and what? Cash account. You now find out the one that is receiving and one that is giving. Bank is receiving and cash is giving. And both of them, bank and cash, both of them are what? Assets. And when assets increases, since both of them are assets, bank is receiving. When assets increases, you debit. You have to debit bank. You have to do what? Number 2, bank accounts. How much? 5,000 naira. Write your naira sign here. Then to what? Cash. 5,000 naira. You draw your line. Make your work very neat. Then go to the next transaction. Bought goods for cash. 6,000 naira. Here, find out the two accounts that are involved. The two accounts that are involved are what? But when you see bought goods in accounts, we don't record bought goods. Because we record is purchases. We don't record book goods. We record what? Purchases. So this is purchases. You made expenses for cash. 6,000. So purchases account and which account is involved here? And what? Cash account. There are two accounts that are involved, purchases account and cash accounts. Which one is coming in? He made an expenses, so cash goes out. Purchases is coming in, purchases increase. And purchases is what? Expenses. When expenses increases, You do what? You debit. Purchases. Purchases accounts. How much? 6,000. Then to what? Maybe to cash account. Cash is also assets, but cash reduce. And when assets reduce, we do what? We credit. Cash 6,000. Then let's work on the first one so that and second one. I'm sure you have copied it. If you have not copied it, you have to do so. Okay. Look at it now. For the rest of transaction, number 4. Sold goods 20,000 naira. The two accounts that are involved here are what? Sold goods. Goods, sales account. Sales account and what? Cash account. He sold goods for how much? 20,000 naira. So he sold goods and cash came in. Yeah? And when cash came in, cash, which is what? Assets. It has increased assets. And when assets increases, you do what? You debit. 4. Cash accounts. It's how much? 20,000 naira. Then sales accounts. Sales is what? Revenue. It's under revenue because it's money. After selling, you do what? You get money. So sales did what? Increases also. And when revenue increases, you do what? You credit. 20,000. Then on fifth, bought goods from A. Whenever 60,000 naira. Whenever you see a name mentioned in an account like this, bought goods from A, you know that is a credit transaction. If not, that A wouldn't have mentioned. So whenever you see a name mentioned like this, it is a credit transaction. Bought goods from A, 60,000. Credit transaction means that he bought the goods, but he did not give A any money. He bought it in credit, so he was owing A. So A is what? Is creditor. A is what? Is creditor. So since A is creditor, creditor has increased, and nowadays we don't call it creditor again. We call it account payable. Account is what? Payable. So account payable is what? Under liability. It's under what? Liability, because we are owing. It's under liability. So liability has increased. Liability has did what? Increase. We bought goods from A, 60,000 naira. And the two accounts that are involved are purchases account and liabilities account. Purchases increase. And when purchases increase, which is expenses, you do what? You debit. Liability account, which is account payable, is under liability. It's also increasing. And when it increases, you do what? You credit. So first one should be purchases accounts. Purchases accounts, 60,000 naira. Then B, in brackets, accounts payable, 60,000 naira. Then let's finish up. Okay. Consist. Sold good to B. This is another name mentioned. It's another credit transaction. So he sold good to B. Then B is owing the business now. B is a debtor to the business. And a debtor to the business is under what? Debtor is under assets because the business is going to receive it in future. This is an asset of business. We say that the asset is what have economic future benefit. So assets, the account receivable, which is asset, is going to be receive a future. So it's going to be under assets. So when asset increases, we do what? We debit. And when two accounts that are involved here, sales and account receivable. Sales account and account receivable. So this one, account receivable, is under assets. So you have to write B, account receivable. Accounts. 25,000. Then to what? To sales. Sales is under revenue. And when revenue increases, you do what? You credit 25,000. Then savings. Received from B 25,000. So B had offset his bill. He had paid the company what he was owing it. So now he received from B. When he received from B, he received what? Money. Received cash from B. Cash increases and account receivable decreases. Are you getting it now? So both account receivable and cash, the two accounts that are involved, cash and account receivable. Receive cash is an asset. Account receivable, that is debtor, is also an asset. But one is increasing, one is reducing. So which one is increasing? Cash is increasing. You have to look at it asset. When asset is increasing, you do what? Debit. And when asset decreases, you do what? You credit. Account receivable, which is debtor, has increased, it has decreased. You have to credit it under account receivable. So first of all, cash account. You have to debit cash account 25,000. Then to what? Accounts receivable. Accounts receivable, just say B. These accounts 25,000. It remains how many? It remains how many now? Let us finish it. Okay. 8. Purchase building for 9,000. The two accounts that are involved, account payable and cash are involved in this number 9. Account payable and what? Cash. And the owner of the business paid his debt of 60,000. So having paid, liability has what? Decreased. And when liability decrease, you do what? You debit. When liability decrease, you do what? You debit. So you have A's account. How much? 60,000. And cash left his purse. Cash is what? Assets. And when assets increases, you do what? You credit cash. The cash 60,000. Then 10. Number 10, sold computer 80,000. Look at it, computer 80,000. Two things are involved. Computer and cash account are involved here. Which one is going out and which one is coming in? Cash is coming in. So we have to debit cash. And computer is going out. So cash accounts 80,000 naira. Then to computer, which is going out, computer 80,000 naira. You have seen it. This is how we post our journal entry. You can see that it is not hard. It is not hard at all. So maybe tomorrow we are going to look into the second method of journalizing our transactions. We now check the one that is easier. If you record like this, you won't have any problem in your future account. By the time you will be diving into the deeper accounting, like profit and loss accounts, balance sheet and others. Having master journal, you won't find anything difficult at all. And with this, we are coming to the end of our lesson today. I hope you enjoyed it. And if you do that, kindly subscribe to my channel so that when another video like this will be released in future, to get to you. Thank you.